go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. Today's episode is going to be another great one. One of the most popular segments of the growing ETF space is buffered ETFs. Well, today I have on the perfect guest to talk about the buffered ETF and how to implement them in client investment portfolios. But today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. I am honored and very excited to welcome Mike Loukas. Mike is the CEO of TrueMark, which is the advisor to the TrueShares ETFs. Mike, thank you so much for coming on the show. It's an honor to have you on. Can you please tell us a little bit more about yourself and TrueMark Investments?
Sure, Ryan. This is a fun segment for me since I'm actually speaking to someone in the Pacific time zone right now, right? Which we're always we're always speaking to other time zones.
Yes.
So I have been in the investment business for north of 30 years at this stage. And I like to say I've seen it all, but as we all know, every week brings something new. And so I've worked in the past in a variety of capacities across almost every type of 40 act wrapper, as well as LPs and hedge funds, and straight up equities back in the day. So through that path, I think I'll launch right into the history of TrueMark if you don't mind.
Yeah.
But during that path, there are stages when you're in the business. And the first stage is sort of, you know, .com gold rush. Let's chase equities. Let's see the day trading. Let's do all that stuff. And then that sort of morphs into, whoops, maybe that was a little overly exuberant. And then it morphed into sort of the 40X space, the fund space. And then eventually along that path, right, you start to look ahead and you realize that, well, ETFs are getting a foothold, they're getting traction, they're going to become a behemoth in the space eventually. And so obviously that proliferated first with the passive ETFs, and maybe in the last 6 or 7 years, active ETFs have really started to scoot. And when we started TrueMark, it was really a play towards the active ETF side of things. And we saw that as the next leg up and decided to get into the space. And we did so back in 2020. We launched our first ETF. In those days, right, as these things morph, in those days, they were called thematic ETFs, right? And so we got into the thematic ETF game with some long-only equity ETFs, concentrated portfolios, more fundamentally approached, traditional active. And then we pivoted the business not long after that because we realized that the direction this was all going was more solutions-based. And by solutions-based, I mean, the idea that we can provide portfolio construction tools that can be used in a multitude of ways, right? The real versatility of that investment and its ability to complement existing investments or handle it standalone. So pivoting into that solutions base is really, I think, inevitably where this was all headed. And I think right now, particularly with the buffered space and the defined outcome products, you're seeing that ripple across the entire industry. And I think it's really advantageous to aggregators, model providers, retail investors, financial intermediaries, you name it. And I think there's a place for a lot of these products in their construction.
Mike, I love that recap. That is fantastic. And I completely agree with you. I've been in the industry 20 some years, and how much, it's evolved. And like not that long ago, just going back to the pandemic,
Yeah.
and it was FOMO and Reddit and
Right.
all that stuff. Like it was just like you said, standoff. You don't want to miss the next AMC.
Hmm.
Or whatever it is. Now we're back to, getting back to portfolio construction, the benefits of portfolio construction, solution-based investments to help create that portfolio. So investors can achieve their goals with higher probability. So such a great, and you're so right. Every day is so different. It is moving quicker than ever.
Yeah.
It's hard to keep up with it.
Yeah, it is. I remember a few years back when, crypto ETFs were
Yeah.
such a far-fetched, thought that they were tabled for seemingly forever, right? Now they're out there. So, but to your point, it's back to modern portfolio theory, right? It's
Yeah.
back to where we started all this, and which I guess is typical of the investment markets, right? Eventually, it all comes back around to basics. And so providing those components is a real key part of the growth of active ETFs and the ETF industry as a whole.
Yep, exactly. And I love it. I love the innovation to help those portfolios get more, whether it's downside protection or mitigating risk, which we'll talk about here shortly.
Yeah.
So you brought up buffered ETFs, and you have buffered ETFs within True Shares. Let's just, what is a buffered ETF?
Yeah. What a fun space, right? It is, it's buffered ETFs, it's defined outcome. We call it structured outcome.
Okay.
So we love to categorize or name these asset classes and approaches. But look, in a general sense, what anything in those categories is trying to do, and I think you touched on it earlier, it's trying to give an investor a more predictable or a higher probability of achieving their desired investment goals. And you do it in the concept or in the construct of a risk profile, right? So basically, what most of these products started out as is, look, you want exposure to equities, the growth characteristics of equities.
Yep.
How can we provide that and smooth the ride? When you see something like the pandemic, or any of the, sort of every decade, you see something that, if not a black swan event, something that certainly gives people pause and says, well, wait a minute, we can't just own equities and expect a sequential annualized return, even though that's the way we all publicize it, right? It's lumpy. It's always lumpy in between point A to point B, but what happens in between
Yep.
is usually a lot of lumpiness. So how do we utilize what's available in the marketplace and try to mitigate or buffer or dampen that risk potential and create, theoretically lower volatility? How do we do that and put it in what we consider an investor-friendly structure, which is the ETF? And I really think that's where the basis of it started, which is, okay, let's go out there and let's look at the S&P or SPY or whatever your chosen index is, something widespread, something most people use and stay in it long term. Let's figure out a way to give them a predictable return, a more predictable return than just long only in the index. And so then it's morphed into, and I think in the past, you and I have sort of used this phrase, it's morphed into a little bit of a ticker soup, right? Where you've got a million ways to approach this now and all different reference assets. And so the game's gotten more complicated because we like to do that to ourselves in the ETF world, right? We pat ourselves on the back for some sort of innovative approach, and then we decide to slice it and dice it so many times, the investor or even the financial intermediary looks at it and says, which thread do I pull on first? Where do I start? But in a nutshell, right, the core of these products, and they're all math, right, for the most part. And so the core of these products is to simply use predictable tools in the marketplace, rely on the math, and give an investor or an allocator or someone, constructing a portfolio the ability to toggle their risk tolerances to fit or to cater to what their desired profile is. So someone needs growth with less risk. Here you go. And there are lots of products out there that can give you, less growth, less risk, more growth, more risk. And it's that simple, that profile that's been around forever, but it gives them more flexibility, more optionality, no pun intended, to create the profile that really fits and customizes to what their outlook is.
Fantastic. You brought up a good point. And years ago, to smoothen out that ride from point A to point B, it was always take your equities, lump sum fixed income in there,
Mhm.
treasuries maybe, and that helps sink that 60-40 portfolio smooth out there. That's not so much a case anymore. Correlations between equities and fixed income have increased, especially during times of crisis. You
Yep.
need other products in there to smooth out that ride, like you said. Um, and that's where buffered ETFs can come into play. When you're creating that portfolio, or financial advisors are creating that mix of assets for a client, what should advisors consider when incorporating buffered ETFs in the client portfolios? Do they think of it as an alternative, or do they think, well, if I've got, 20% in the spider, do you take a certain percent of that and kind of hedge it with a buffered ETF? How do you incorporate it?
Yeah, I mean, I think you start there, right? And what you first need to do is you need to step into it and you need to analyze, what that particular portfolio is trying to achieve. And in that sense, it's almost reverse engineered, right? Where you say, I need equity upside, but I need reduced volatility, or I want to mimic a 60-40 volatility profile. And to your point, maybe the building blocks of a 60-40 profile have changed just because of the correlation between asset classes, or
Mhm.
back when we were in super low rate, extreme low rate environment, then that certainly has an impact on how that works. So you're going to take the components, pull them apart, look at them, and decide what fit, what combination of these components is going to give me the equity or the growth properties that I need and maintain the risk profile that I'm comfortable with. And so that's really, I think, the first discussion. And when you gather that, then you'll have a better idea of can I do, if I have a 25% allocation to large cap US equities, what do I do with that, right? Can I tolerate the typical volatility of that segment? If I can't, if I'd like a smoother ride, how much of those growth properties do I intend to harness? And where's the proverbial, there's no free lunch in hedging. So, where is my equilibrium and how do I achieve that? So, I always say that the key to these products is the versatility, because no matter what you're trying to do, you can dial up, dial down, toggle back and forth. You can figure out a combination that works. And I think, obviously one of the sponsors of your show, I mean, a company like Zephyr or many of the companies out there, they can help you analyze that risk profile or that risk spectrum for you and understand, what you can tolerate within that portfolio.
Mhm.
So that said, we deal with equity reference asset classes, right? So for us, we have products that are quarterly hedged. We have annual buffers. We have turnkey solutions. So it's understanding the asset class you want the exposure to, understanding what type of return is acceptable to you. And you can even take that from the institutional space, right? Remember, all the institutions have a bogey they need to hit annually. So maybe the client or the person constructing this portfolio has a target outcome that they are willing to accept, regardless of what the broader market does. And that will dictate how much of a volatility dampener or a hedge position that can be attached to the product and still allow for that. So to answer your question specifically, um, we see them used standalone to replace all equity exposure. We see them used blended with a core equity exposure. And again, it depends on the reference asset. So they have a place in whatever sleeve that you can mimic the reference asset in. And it all depends on whether or not that particular portfolio is dialing up uh, risk or dialing down risk, and where that acceptable equilibrium is. Because as I mentioned, these are math, right? By and large, these products are math. They will do what the math says they will do. It's just a matter of matching up expectations with the actual investment approach. And that's what I love about this space. It's math.
Yeah.
No one's sticking their finger up in the air and saying, hey, if we do it this way, there's a high probability we'll get this outcome. No, it's math. They're saying this is the outcome that, the outcome range that can occur in this product. And I think that's hugely beneficial to someone trying to construct a forward-looking risk tolerance and matching it up to what their investment needs are.
We often talk, one of the hardest things about, doing, whether it's a efficient frontier or creating something, is what are those expectations? How do
Mm.
you set those expectations, those risk return expectations moving forward? And that's fantastic. Buffered ETFs give you, a more solid expectation and moving forward. It helps you fill in those, to build the efficient frontier to optimize those portfolios, which is fantastic.
Yeah.
Um, so I think this is pretty obvious question based on what you've already talked about, but why? Why should financial advisors consider buffered ETFs?
Well, again, I think it's that idea, and if you look at the demographic sort of shift in the U.S. in particular, if not worldwide, you've got a lot of folks moving from the accumulation phase to the distribution phase. And furthermore, you've got a lot of investors that still need growth. They don't have enough to retire completely, or they still need growth in their portfolio, or it's someone building towards that, in their prime earning years.
Mhm.
So I think investors are warming up to the idea that when you look at compounded returns over the years, if you look at compounded returns, not losing money, and we'll call that the left side of the volatility spectrum, the left tail. So truncating that left tail is very meaningful to your ability to create compounded annual returns. And when you think about lumpy returns, non-sequential returns in the market, it becomes more impactful. And I think that right side, which is the upside volatility, that you want to capture as much of that as you can. Again, there's no free lunch, so you've got to find your
Yeah.
equilibrium. But it really comes down to, look, am I in a phase of conserving my principal, maybe creating cash flow or income, and what does that look like? Well, that's one approach that has to be addressed. The other side of that is, am I in a space where I'm trying to conserve principal yet still grow?
Mhm.
And that's the sweet spot for these, right? That's where you say, look, we can take on his exposure to what is historically an outperforming or a positively performing reference asset or an index, and mitigate the drawdowns or buffer those drawdowns or protect against those drawdowns. So what you're trying to do is you're trying to address both sides of the volatility spectrum based upon what your needs are, right? So if you need equity exposure, you need growth. There's a product out there for you. It might be the True Shares product, right? Because we approach it a little differently than our peers, where you've got that uncapped upside and you're trying to capture as much of those lumpy up years as you can. But if you think, listen, I don't need much growth, but I do absolutely want extensive principal protection, then you go with something that's got a deeper buffer or maybe a harder hedge on the downside versus a buffer, which is, I consider it a soft hedge, and maybe less upside, right? So it really comes down to what that investor profile is and what you're trying to accomplish with the portfolio. And all that sounds like I'm just continuously saying the same thing, but that's what it comes down to, right? It really starts there, and then you have to reverse engineer and match up what these products can deliver relative to the expectation of that investor.
Yeah, Mike, I often talk about that, like how do you incorporate it? What's the perfect investor for a product? And really it comes down to, as a financial advisor, you just got to know your client,
Yeah.
right? Know your client, understand what their objectives are. That's really the bottom line. You talked, and I love it, about risk and risk mitigation. We've done a lot of research here at Zephyr about risk and, how do you create, optimize portfolios, to enhance that Sharpe ratio,
Hmm.
increase the return per unit of risk. And, we've done a lot of research, and a lot of people talk about volatility or standard deviation as the main risk um, for investments. But really, what we've determined is volatility may not be bad, especially upside volatility.
Right.
And you've mentioned it a few times here about drawdown risk. You
Hmm.
know, limiting that drawdown. And that's what we focus on here, and find that losing your money is your ultimate risk when investing. What does buffer products help reduce? Is it more volatility? Do you focus on the drawdown risk? Is there a certain type of risk that buffered products help reduce more so than others?
Yeah, I think it's drawdown risk, right? So, you'll see it, but the reality is you're protecting yourself against um, what is considered a normalized drawdown, right? I'll say that. So, if you think there's going to be a black swan event and the market's going to drop 30%, there's a way to protect against that. But in a typical market cycle, we've always found 10% to be the sweet spot, on an annual basis. So significant drawdowns are what you're guarding against with a buffered product. Because in that sort of black swan scenario, if, for example, if we have a 10% downside buffer and the market's down 30, market's down 35, market's down 40, um, that you're mitigating some of that, but you're feeling the pain.
Yeah.
And there's likely issues across several asset classes at that point. But the reality is it's approaching that left tail and truncating it and saying, look, if the market's down 20 and I'm down 10 hypothetically,
Mhm.
that's acceptable relative to what my upside potential is. And so to your earlier point, you're going to speak to that portfolio or that investor and say, what am I trying to do here? And if it's, look, drawdown risk is my number one concern, there are ways to deal with that. If it's, I'm not worried about drawdown risk because my time horizon is significantly elongated and I can tolerate some volatility, because I know that, there will be good years, there'll be bad years, and there'll be lots in between. And I don't necessarily want to um, tactically move my money in and out or truncate either tail. But what I do want is I want the ability to reduce some of that downside volatility because of the math that plays out over the long term.
Mhm.
If I lose less than that compounded return over a long time period will ideally be significantly greater than if you participated in those downside moves. So it's time horizon, right, Ryan? So it's kind of like my time horizon. Here's my risk tolerance. This is what lets me sleep at night, and here's my time horizon. Let's function those together and decide if you're really protecting against drawdown risk or trying to optimize compounded future returns by buffering out some of that downside. So they can be one and the same, or they can be two different things entirely.
Fantastic. And, some of the research I've done, every year, whether, we've had a great market the past couple of years, whether it's up 25% for the year, 30% for the year, there are always going to be times during the year where you get a correction, 10% pull down, pull back.
Mhm.
Despite the year being a phenomenal year, buffered ETFs, it sounds like, can really help mitigate that 10% drawdown. And so you can capture more of that upside.
No question. You've been in the business a while. I've been in the business a while. Tactical managers, good ones, are really hard to find.
Yeah.
In the good ones, you can't find them by design, right? Because they don't need you. But it's this is about taking the tactical to the extent possible, taking the tactical out of that annual profile so that you can let the market do what it's going to do, because historically it's done, the longer time horizon, the better it's done for you.
Mhm.
And so you can let the market do what it's going to do, but you have that ability to help yourself sleep at night and remove the emotion from it, right? We all know that emotion is such a very distinct enemy of good investing in many cases. And so it helps you remove that emotional component, remove that urge to tactically maneuver when the best move may just be standing pat.
Yeah. So you've done a fantastic job talking about buffered ETFs. What's your approach, and your firm's approach at buffered ETFs? You mentioned it too just a little while ago about capped versus uncapped strategies. What is
Yeah.
it? What's a
Yeah.
capped versus uncapped?
Yeah. So, again, the free lunch, no free lunch caveat, right? So, most of our peers in the space, and we always say, look, they all work It's just dependent upon what you need for your particular investment profile. So we took a little different approach than most of our peers in the space, and so we're the longest running uncapped buffered strategy. And what that means is in a typical buffered ETF, at least in our space, you would have a downside buffer, and then you would have one for one upside participation on the reference asset, let's just say SPY, to a cap, right? So your upside return gets truncated at some point. And we're a little bit more bullish in our approach, particularly to large cap equities. And we say that, look, we'll have a downside buffer there. But what we'd rather do is we would rather have unlimited upside
Okay.
participation, but to a ratio. And what that means is you may have the 10% buffer on your product and something between 75 and 85% upside capture on the reference asset over 12 months. So if you look at our profile versus a capped peer, say the market's up 10%, the capped peer is going to win. The capped peer will be up 10, and maybe we'll be up, 7.5 to 8.5, and that's all, gross, right? So I don't want to step on anybody's toes in terms of how they incorporate their fees, but and then if you're up, if the market's down 10, then we all have that buffer there. If the market's up, and it happens way more often than people think, if the market's up double digits, and if the market's up like last year, market's up in the 20s, or maybe, coming out of the pandemic, in a 12-month look back, starting in mid 2020 to
Hmm.
mid 2021, the market was up 38 or
Yep.
39%. Uh, then that uncapped upside really means something because you're talking about capturing 31, 32% of that up move. Or you're talking about, a scenario where the market's up 25% even. You're talking about capturing a ratio of that move without a cap.
Hmm.
And all we're saying by that is simply, yes, we want to truncate the left tail to the extent possible. That will help with long-term compounded returns. But we also don't want to miss out on those big, chunky right tail events that are equally important
Hmm.
to long-term compounded returns. So how do we address both of those priorities in one product? And that's where we came up with the uncapped approach. And that's because we believe that, yes, buffering out drawdowns and buffering out downside risk is very important. We also believe that missing out on those big chunky up years or missing out on the potential of those big chunky up years can also have an effect in long-term compounded returns. And it's not a negative effect in the sense that you miss out on it, but you're just not capturing or harnessing enough of it for your long-term compound returns to get where they need to be. So that's our approach. It's a little bit more bullish, if you will. But we believe that by and large, people want equity exposure because of the growth characteristics. And we don't want to remove those growth characteristics uh, when we approach the volatility dampening or the drawdown dampening. And we chose this way to do it, and it's been running strong for about 4.5 years, I think, since we launched the first one. And they've got pretty good history out there for people to check out and analyze as they see fit. But we're pretty happy with how that approach has played out.
I love it. And you know what, Mike, you're exactly right. You want that everyone, and then you said there's no free lunch. That downside protection. But to be able to capture more of that upside is very appealing, knowing that you can still sleep at night and you don't have to worry so much about capturing all that downside, especially like you said, as demographics are aging, very important aspect.
Absolutely.
Mike, thank you so much for coming on the show. It was an honor and a joy learning about buffered ETFs and kind of getting a recap of the history of 40 active funds and stuff like that. Great conversation. Where can our audience get more information about TrueMark and True Asset Investments if they want to learn more about your buffered ETFs?
Yeah, I always say listen, first stop is the website. You know, the great thing about ETFs is we put a lot of information on our websites, and it's true-shares.com. So TRUE-shares, SHARES.com. That's the first stop. And if you have a preferred research site, you know, out there, there are many of them. Obviously, will our information be aggregated there as well. But check out the website. It gives you a rundown on everything we offer and gives you several ways to contact us if needed.
Fantastic. Leading up to this, I went to the True Shares website. Fantastic information, some great
Thank you.
research, thought leadership, and just education too. So you guys are doing great stuff. I can't recommend it enough
Thank you.
for the audience.
I appreciate that.
Thank you so much for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all the other podcasts and episodes on the Zephyr YouTube channel. And lastly, please give us a follow on the Zephyr LinkedIn page to learn more about Zephyr and the research and information that Mike and his team are producing. Thank you very much and have a great rest of your week.
You too, Ryan. Thank you.